Welcome to Trading Blows from TraderX, the show where we put three experienced market participants head-to-head over 4 rounds, discussing and debating all of the major topics and narratives on top of traders' minds right now. Let's have a look and meet our panelists who are going to score points for a great response and have the threat of points being chalked off if a dispute is raised over their answer. The better the answer, the more points they will score. Joining us today, David Belle, the founder of Macrodesiac, a macro analysis service; Ryan Paisey, the founder of PIQ Suite, a market intelligence and news platform, which is also plugged into traderx.com, I should add; and Richard Matthews, the founder of Pardus FX, a specialist FX provider for private, high net worth clients, corporate and institutional clients as well. Plenty for us to get into on today's show. We'll discuss risk assets and their strong start to 2023, the diverging data surprises that we've seen in Europe and the United States. We're going to have a look at next week's big week of central bank decisions and whether markets are correctly pricing the policy outlook. And we'll wrap up with a look at the economic reopening in China and how that could shake up the macro landscape as we move through 2023. That's enough talking from me. Without further ado, let's get into it with round one. So as I said, risk assets have had a strong start to 2023. The S&P 500 has rallied around about 5% or so. European equities have had one of their best starts to the year on record. What do we think is the catalyst behind the move, gents? And do we think that the bulls are likely to stay in the driving seat for some time to come? I'm going to start with you, Dick, as I know we discussed this last night and you've got some pretty tasty views on it.
I fundamentally, good morning, I should say, and I'm glad to see, Michael, that you've dressed correctly, unlike the other two. And I think we start off by scoring a point for wearing a tie and a shirt.
Anyway, you will get a bonus point for a tie. There we go.
Thank you very much. Moving swiftly on, I was always brought up to believe not to fight the Fed and not to fight the markets, and I can't believe what's going on. The market's playing chicken with the Fed. I think that they'll end up getting it wrong. I can't believe the bullish market in risk assets, and I certainly wouldn't be getting involved in that.
Well, very, very sage indeed. Ryan, what about you?
I'm with Dickie as always. Don't fight the Fed and etc. But I think maybe this risk rally is somewhat to do with the fact that the spark for the risk rally, should I say, is the realization that the Fed won't be hiking forever. I think considering where we were a couple of months ago, there was, it was a completely different dynamic. I think there's plenty of people that are, very, as in Dickie's boat, plenty of people very keen to kind of insist that this isn't a full-on risk on rally and kind of the worst is behind us and it's more of a bear market rally. And as Dickie says, the risk is misplaced. I'd love to say the rally has legs. I'm not sure it does. Again, falling into Dickie's way of thinking. Funny enough, I believe it will be the tech side of the tech assets that will be the party pooper, and we're seeing some pretty negative earnings coming out already. But then, taking it one step further, you get the whole, if we see enough downside, we go back to the bad news is good news kind of situation again, in which case we could see central banks come to the rescue. And by central banks, I mean the Fed. It's taken a lot of people by surprise. I think that no one can disagree with that. If I was going to put a trade on right now, perma bull that I am, I think I'd still back equities, but I would maybe be looking for an equal weighted SPX play, or maybe something along those lines. I definitely wouldn't be siding with the tech kind of area, because I think as I've said, we've all seen that tech is being the letdown at the moment. It's a strange one. I don't think it will take a lot to rail.
Yeah, it's definitely a strange one. Let's bring David in. I think Ryan raised a good point there about, do we get to a stage where bad news is good news again for stocks? I guess that rests on the whole idea that the Fed put still exists, that policy will loosen if we see data soften and the market come lower. Are you in that camp as well, David?
Yeah, to an extent, but I think if we take a step back and have a look at maybe the anatomy of why this rally's occurred, through 2022, we've seen that global central bank balance sheets have fallen, which is obviously a proxy for liquidity, aggregate global yields, that kind of thing. And then kind of at the end of Q4, that ticked up. And this was predominantly driven by the PBOC and Bank of Japan. Now, rather than necessarily focus specifically on those two economies and the assets contained within those economies, I think it acts more of a proxy for global yields. We have seen the 10-year, for example, soften a little bit, which is obviously going to give a little boost to certain equity pricing models. But also we've seen the terminal rate, remain pinned at about 5% for a while now. It's not really budged at all. So if we're looking at those kind of differentials, you've got global liquidity increasing a little bit. You've got the terminal rate not really budging, people pricing it in more and more. I think it is definitely down to positioning as well. But if you look at inflows, it's not just short covering. People have entered the market more strongly than they had in Q4, Q3. So I think there is a case of, there's intent behind it. But it's kind of on that precipice of, okay, what could trigger another sell-off? Is the liquidity in the market's still not fantastic? Even if you look at ES liquidity, the cost to do 5 lots is still well above trend over the last 2 years. Treasury market liquidity is still crap. I saw some.
Dave, so when you talk about liquidity though, do you see that changing in the near future? Because I don't. I think this is just a new kind of the new landscape that we're in. I think a lot of kind of where the volatility was a lot lower pre-COVID, market makers breed increased liquidity, which breeds cheaper to do a trade. I think since COVID and stuff, I think a lot of that order, the resting orders, I think I'll be surprised if we see that coming back in until rates level off again. So I think that's something.
100%, mate.
I think that's something the market's just got to kind of learn to live with, is the fact that liquidity isn't going to get back to pre-COVID levels for the foreseeable future. Well, probably until we get back to zero rates from the Fed.
Yeah, oh, absolutely. And you know what? I don't even think the risk in when liquidity is like this, when market makers aren't in the market, as they were. I don't think the risk is just a market that just kind of goes down softly. I think the risk is when you get those big fat tails and you see just massive dumps when everyone's out of the market, when an algo goes.
Look at NYSE yesterday, right?
Well, yeah, exactly. These you start to see these little fractures starting happening, and I think that was a very interesting case yesterday. I think I saw on News Squawk, they didn't even know what was going on at the time. So you do start to see these little fractures in the market and things happening, and yeah, I think you're absolutely right. We're not going to return to pre-COVID liquidity until interest rates get back lower, which just breeds more volatility. So it's a dangerous market to be long in, but it's also quite dangerous to sometimes.
I think it's just a dangerous market to be in.
It's honestly, since the start of the year, exactly. The only trade that I can see as being one might work out is a bear steepener. Maybe 3-month, 10-year, and it's a difficult, but it's a difficult construction as well. You've got to hedge out the duration and all that kind of stuff, and it's like I'm just short cable at the moment, and that's all I kind of know. Do you know what I mean? Well, you have to be. You kind of have to.
Minus the point. Minus the point.
We'll get on to the pound in a short while. What I want to do just before we move on to the next round is just ask you all. We're going to have this panel back together in a couple of weeks. When we next record a video as a foursome, one word answer: do we think the S&P will be trading higher or lower than where we trade now? Dick, you first of all.
Higher.
Ryan.
Higher.
David.
I think it'll be lower. I think, but not by much. I think we're pinned around this level for a while. People always talk
higher or lower. Simple.
It's a very long one. Out of it.
Around here.
Without further ado, let's get on to round two. So it's not only equity markets that have surprised coming into the start of 2023, the consensus expectations in terms of economic data have surprised as well. Eurozone figures consistently coming into the upside, pretty much every investment bank in a rush to ditch their Eurozone recession calls. Well, the opposite is happening in the United States. This whole theory of US economic resilience really starting to be put to the test, with data softening in the consumer space, in the housing market, in the industrial production. The PMIs yesterday not great either. And in fact, Eurozone data is now surprising to the upside by its biggest margin relative to US figures when you look at city surprise indices since the spring of 2021. Jens, what do you think is the best the best way, I should say, to trade this theme? And do you think that this sort of divergence and this broad rotation that we're seeing into Europe is something that's likely to continue for some time to come? Ryan, I'm sure you've got an opinion on this.
Well, firstly, I would like to introduce, on the game show vibe that we got, I'd like to introduce PIQ's mascot, Nelly the elephant. He will be making multiple appearances throughout the course of the series.
But bonus points are only available for ties, not for mascots. Let's make that very clear.
Point deduction there.
Look, you're lucky I'm dressed.
Very lucky.
But anyway, I digress. Data. Okay, first off, data all over the gaff. I know that's very helpful, but it is what it is. Like you said, softening in the US, firming in Europe. You're only as good as your last data points, so that could easily flip. However, I would say we got to kind of try and think about why the data is firmer in Europe at the moment, relative based. Again, we've just had some sentiment data out this morning. IFO, it's again, seemingly optimistic. And why is that? Personally, I think it's all down to the lack of a gas crisis. Everything stems from the sentiment and the survey data, really, when you think about it. I know people hate a survey, but at the end of the day, people's outlooks are what feeds into everything. And we were so front running in Europe that we're all going to die mentality of a massive gas crisis that just hasn't so far, touch wood, hasn't happened. And that's feeding through to the data we're seeing now, ultimately, in my opinion. And again, have we just front run the we're all going to die moment? Yeah, probably. So now everything looks a lot rosier. If you are going to trade the divergence of the data, it's Forex isn't my bag at all. You could say trading isn't my bag at all, but Forex trading definitely.
Well, I didn't want to go there, but now you.
I'm just a news aggregator. I think you're obviously looking at euro dollar, and who better to speak to about currency markets than Dickie and David. If you are forcing yourself to trade data divergence, I think you're looking at euro dollar, as I said. However, something that I think possibly worth more looking at, just from my own personal preference, the DAX has got to be getting your attention. If you really believe that we haven't fully priced in this overemphasis on the gas crisis that never happened, then you've got to say that the DAX has got room to the upside. Why I like the DAX as well, and I know we're going to come on to China a bit later, but the DAX also gets a really healthy bid from Chinese positivity in terms of reopening and stuff. And also, to be honest, it's an easy play. It's very basic. I know David before was saying about bear steepness and all stuff like that, but who's got time to work out that?
Well, hold that thought on China. Dick, I want to go to you. We're having a milder than expected winter. It's probably not particularly warm when you're swimming in the Channel, mind. What do you think in terms of Europe? Are these upside surprises going to continue for some time to come?
I think the real difficulty is that none of us have ever seen COVID or a pandemic before in our trading careers. Certainly, I started when God was a boy, as David Buick would say. I haven't seen anything like this before. And I think it's really, really hard to read data. I think the whole data sets have totally changed over the last 2 or 3 years. So I'm not sure how much we should draw from them for a start because of that. Secondly, Ryan is right. It's been a very, very mild winter, apart from the odd day or so. Germany's got off lightly, but we're still only January. We've got another couple of months to go in winter, which I think you could see a shock come in there. And what really worries me, and I'm going to be Mr. Doomster and Doomster here, is we're arming Germany and Poland and America's rearming the Ukraine to take on Russia. I think there could be a really nasty shot from Putin's response. We'll just think, oh, we can send tanks, we can send this, we can send fighter airplanes. Putin's not going to do anything. I don't believe that's necessarily true. And I think you could see an escalation in the war there, greater than anyone's anticipating at the moment. So that would be my one worry about Europe. But having said that, as you know, we said last night, trading FX, I'm going to have to wash my mouth out shortly.
Oh, no. I know what you're going to
say. So we've got a bit of doom and gloom from Dick. We've got rays of sunshine from Ryan. Yes, that might have been a line I prepared before.
Can I quickly just add something to Dickie's point? Because I think he made a really, really good point there about Russia and the Ukraine-Russia war, or Russia-Ukraine war, however you want to say. News, as we know, news flow is my bag, right? One thing I have noticed is it's almost been the emphasis on what's happening over there has completely faded out of the market. The headlines that would have moved the market, a percent or so 6 months ago, the same headline now is not even registering. I think we've all got a bit too accustomed to what's going on over there. And as Dickie said, it wouldn't take a lot for a headline to come out a situation to happen that really re-shocks the market, if that makes any sense.
I think as well, most of the headlines coming out of Ukraine, Russia is very, very pro-Ukrainian. You don't necessarily know that's the truth because they're considered, the good guys. Which, I'd say the same. But the fact of the matter is, I think the market is very much one way. It's very much one way in terms of, oh, Ukraine's winning, it's all good. When, as Dickie and Ryan said, is that Russia could come out with some pretty nasty stuff. They are a nuclear power at the end of the day. They've got that Satan missile, which is bigger than anything the US has. Putin's on his last legs, maybe, whether you believe the rumours, with the cancer. So he could just have one last hurrah. And the other issue is that there's a power struggle within Putin's circle too, especially with this Wagner group. And this Wagner group is pretty much insane. They've committed atrocities all over the world. I think at the moment there's some protection of Shoigu because there's a power struggle there. Don't even know if that's how you pronounce his name, but that's what I read. And I think there's some actual nutters in Putin's circle that even if Putin went, maybe the same or worse could occur.
Is this something you'd be actively hedging for, David, or would you just kind of keep this on the radar as a bit of a tail risk and remain bullish Europe in the meantime?
Well, I've been short the DAX in different sort of ways and methods over the last year or so, because ever since I saw that they were taking blood to the front line, which was back in February of last year. I'm offside. No, not on the entire position. I'm offside on the current sells, all right? Which is fine. Okay. It's good to feel some pain sometimes. But it is what it is, and it's one of those things where I guess I'm only in DAX minis and micros as well, so I'm not on FDAX. But I think if it's one of those where you are betting for some escalation and you do believe that the market is well sort of overpriced, I guess, that it's not going to get worse, then it's probably a good place to be a seller.
I certainly think it's more dangerous to play chicken with Putin than it is with the Fed.
Yes. Yeah.
I think we don't agree with that. What's your drink? What are you drinking now? You're on Lucas Aiden vodka or something?
No, it's a very weak vodka cranberry.
That's okay.
Before we make our way any further down Ryan's cocktail menu, let's get back to the macro and have a look at the policy outlook in the third round. Right, halfway through the show, Dick is lagging behind slightly, so we'll go to him first of all as he says cheers to us with his water. A very, very busy week next week as central bank meetings. As David alluded to earlier, the market sees the Fed funds rate peaking just shy of 5% and then being cut pretty quickly and pretty pretty aggressively from there, with around about 60 basis points worth of cuts priced in the second half of 2023. The ECB were pricing a terminal rate just north of 3.25%, and then the market expects us to hold there for some time. And just down the road on Threadneedle Street, the market expects the BOE to get to a whopping 4.5% and then cut around 25 basis points by December. Dick, what do you think is priced right? What do you think is priced wrong? And how do we trade next week?
Big week, isn't it? I think that the ECB's the easy one. I think you got 50 basis points nailed on there. They've been absolutely clear on their forward guidance. I don't necessarily agree with it. I'm not sure they're right, but I think 50 basis points nailed on there. I guess the Fed's going to do 25, although I wouldn't be totally surprised if they came out with the price at 50, which I'll circle back to in a minute. And the difficult one, as always, is the dear old Bank of England, who love to prevaricate, ruled by committee. I think they'll disappoint. I think they'll come in with 25 basis points. Why I think the Fed may be the surprise is how many more times did Jay Powell have to say, we're not pivoting? You know, he says ad infinitum, higher for longer. And I think sooner or later there's a shock going to come out to the market, whether it's next week or whatever. You can't just say, okay, we've done 25, we're higher for longer, we haven't finished yet, because the market's going to ignore it and rally. Risk assets are going to increase, and they're going to get looser financial conditions over there. So that would be my one, which could be the big shock. Whatever the Bank of England does isn't a shock anymore to me. If they did nothing, I would be totally amazed. I have to be polite about the dear old lady. I think they've been less than impressive.
Yes.
Well, I have to be polite as well, because if I speak loud enough, I'm probably within earshot of them. But one trade for next week, what is it in your mind?
God forgive me for saying it, I'd buy the euro and sell sterling.
I knew he was going to say that. I just wanted to make you go through the pain of saying it again. So, David, what about you? Do you think the Fed will come with kind of shock and awe, or do they just go with the 25 pips we're all expecting and move on to the March meeting?
I don't know. Personally, I tend not to even bother anymore trying to work out what they're up to. When you look at the market on Fed Day, it can just defy all odds. I don't even think the last time I bet on a Fed Day, I probably lost. I can't even remember the last time I did it. So
for me, win on a Fed Day?
What's that?
Is it possible to win on a Fed Day?
No, the market just looks like a heartbeat monitor at the end of the day. Go up, go down, somewhere in the middle. It turns into NFP, but for me, the key really is the terminal rate. You know, if you're looking longer term, you know, more than intra-week, then the terminal rate is the absolutely key factor. Now, if after this meeting does that change, then that changes my view for the next maybe 2-3 months. If it still remains pinned, and then we see those other factors that I mentioned, you know, like global aggregate central bank balance sheets increasing as a proxy of liquidity. Of course, there's other components there as well. Then perhaps that could lead to a more sustained bid, as it has already. But still, you know, the trade for me is short cable. I think that the data coming out this week from the Treasury, you know, it defies all sort of it defies all manner of logical thinking as to what's happened with the UK government over the last 4 or 5 months.
I consider the UK government's logical.
Yeah,
well, yeah, exactly. There is that as well.
They've done.
But
illogical, maybe.
But you know, my issue has always been,
I said illogical, maybe.
My
but
issue
not
always was that trust. Yeah, my issue was always that Truss had the right idea. It was just very mistimed. She did it right at a time when there was just too much sort of nonsense going on. Market hadn't digested interest rates enough. The Fed had literally hiked rates the day before the policy was introduced, but it was the right policy in my view. But now, you know, Sunak's government, we've seen that they've got the highest, I think it's the highest borrowing, I can't even remember the actual data point, highest borrowing yesterday, with not much to show for it. Whereas at least Truss was looking at growth, you know. So I think that's going to be a real sticking point.
Speaking of growth, let's point out that the Times reporting this morning that we're about to get a downgrade on the medium-term growth outlook by the OBR, which it's not going to be well received by anyone.
And the ONS had to revise their 5%. I think it was hourly output per worker estimate in 2021 from 5% to negative like 0.1%. Which
when has the OBR been correct about anything?
It's very true. It's very true.
David, I just wanted to pick you up on something about the terminal rate. Do you think the terminal rate's more important than the length of time that the terminal rate stays where it is?
Ooh.
That's a good question. I mentioned that it'd been pinned at around 5% for a while, and I think you're right. It can kind of deviate around 5%. We've been at 4.9%, gone up a little bit to 5.1% certain time. It depends, I guess, on the amount of the extension beyond 5% or below. But for it to be pinned at 5%, I think that just indicates that a lot of the news, if you like, or data is very much priced in a lot of market participants' hands, and it would take a shift of that to change that interest rate narrative, maybe.
So I think, having grown up in a market unlike the rest of you, when interest rates in 4, 5, 6, 7, 8%, when
during the war,
in the Boer War, that was the start of my that we're in now in a new environment where you're going to get interest rates at 4 and 5% and get used to it. And I think people say, we're going to cut in the second half of the year, disregarding the Bank of England, because they'll probably look for negative rates, that you could still be seeing rates at 4.5% this time next year in the States.
Ooh.
I think that people are building expectations that the Fed will come to the rescue and cut rates. I think they're wrong.
Ryan, let's bring you in. I think
could very well be the case that remains sticky.
Let's have a look particularly in the BOE a little bit more.
Quick fire on the BOE and the others, other major central banks. Like I said just now, obviously we've just had the hint from the Times earlier that economic forecaster is going to downgrade medium-term growth outlook, which obviously is not a great sign. We've also had today's PPI data, another sign that inflation is fading. Manufacturers reduced their prices by 0.8% in December versus November, and that's the biggest drop since April 2020. BOE, I think they're going to love that. Gives them even more of a excuse not to keep hiking. I think 0.5% is completely priced in almost. It's not priced in, but as Dickie's alluded to, you can't trust the BOE at all at the moment. I think if you're gonna gun to my head, if you wanted a surprise, they're probably it would be 0.25 point hike. I don't think that's completely an irrational idea. Again, remember it'd be the 10th hike in a row, which is pretty crazy. I'm not a big fan of Dickie's trade of long euro, short sterling. I think, kind of going a little bit off on a tangent, I think you got to big up to the Bank of Japan. Obviously, there's a lot, we're not used to talking about the Bank of Japan because not much goes on there. But, it's going to be quite a pivotal kind of first half of the year, maybe first quarter of the year, with new governor coming in, like Bank of Japan, likely to start phasing out the extraordinary measures on yield curve control, etc. First time in forever, they're seeing some inflation. Ironically, it's not for want of them trying to buy inflation, it's more kind of spillover from the rest of the world. Again, as we said a few times, as I've said a few times in the already today, Forex markets are not my bag, but gun to my head, one Forex trade I do like quite a lot is long the yen index, which the code on Pepstone is JPYX. Just get one out. I don't know if I've done my own work. But it's that'd be my trade on that front. In terms of ECB, obviously February 2nd meeting, same day as BOE, 50 basis point hike, fully priced in almost. Tiny chance of 75 hike. With the positive data we're seeing, again today we've seen more positive survey sentiment data. Gun to my head, you're gonna say if there is a surprise, it'd be for 75 basis points. That makes sense. And again, it's rattling that kind of central bank divergence rattle, which we haven't seen in forever. Lastly, just quickly on the FOMC, obviously the day before, BOE and ECB on the 1st of Feb. Again, we've got a result pretty much fully priced in, which is 25 basis points. I think the recent tech layoffs and tech weakness in earnings is probably putting a smile on the faces of FOMC members, even though they don't, I'd say they don't like to admit it, but they are admitting the fact that they want to see a slowdown, and that's exactly what they're getting, which in my opinion takes 50 basis points completely off the table. How much pain until they start thinking about cutting? Obviously not in the foreseeable future. In the latter half of the year, possibly, in my opinion. I think just highlighting the pivot, as Dickie mentioned earlier on, I think we do need to remember that not hiking by 75, not hiking by 50, but still hiking by 25 is not a pivot. I think it's, when is a pivot not a pivot? And me and Michael, we've discussed this in the past. As long as they're hiking, they still haven't pivoted. So I think that's very important to remember. I think they pricing in 60 basis points of cuts in H2. Feels about right. Gun to my head again. I hate using that phrase, but I've overused it already today. But central banks, they're so data dependent. It's all complete guesswork, in my opinion, at the moment. Until we get.
I want to jump on that point you made about rate cuts very, very quickly before we move on to the next round. I want the name of one central bank. Doesn't have to be these three. Any G10 central bank. Who do you think is going to be the first to cut rates? Doesn't have to be this year, but who do you think in this cycle will be the first? Fed. Ryan's going with Fed. David.
Fed.
Yeah, I'd say Fed as well, but the thing is that there's probably a better bet on the Bank of England doing it, because they're just mental, and they just do things that are totally surprising for no reason. So especially if Tim Ray-Ro's there as well, Scooby-Doo.
Ray-Ro?
Yeah.
Sorry, just for the guy, you've got to say Tim Ray-Ro in the Scooby-Doo voice. It's the law.
Yeah. And Dick, what about you?
She would love to be buying $100 billion of gilts a day, £100 billion of gilts a day. So, yeah.
Bank of England for me, first one to cut.
Ooh.
Unfortunately, I agree with you. I think they might well be the first to cut as well. Without further ado, then, let's head over to China, round 4. So, China, last round. China's reopened much more rapidly than most people have been expecting. I don't think the full sort of unwinding of COVID measures was really expected until at least the second quarter. But things are pretty much getting back to normal very, very quickly in China in terms of economic rules and restrictions. And in terms of the virus, they seem to be past the peak in terms of cases and in terms of deaths, if you start to dig into the data a little bit more, although the usual caveats, of course, apply with any figures that we get out of China. The key question for markets, though, is what do we see next? What impact does this have in terms of the economy? Is it an inflationary force? Is it a disinflationary force? And does this present any opportunities? And particularly, if I can get my words out, in the commodity space as demand starts to come back in China. Ryan, this is your bag, commodities, so let's get going.
Well, let's not get carried away, but I'm very glad you mentioned commodity space, because I've got my trade for this segment is long copper. Probably because, firstly, I've got to say, I'm extremely surprised by the fact that China stuck with the zero COVID policy. The anti-zero COVID policy. I did think that, reopening into traditional flu season, they would attempt it and then they'd just fall back. So fair play to them. Is it indicative to just how desperate they were / are economically? Yeah, probably. But they're making all the right signs for a sustained reopening. We heard today the Nikkei reporting that they're taking additional steps to open up markets to foreign financial companies. What possible flies in the ointment? The only one really is some kind of mad re-escalation of COVID. But given how they are very one, how kind of they manipulate the data. Could they just ignore a ramp in COVID cases? Probably. Are they already doing that? Yeah, probably. Globally, is it inflationary? I think, it all stems from, demand from, the base metals and stuff coming up through, just the overall global demand. So yes, it is inflationary globally, but we're coming into deflationary deflationary kind of landscape elsewhere. So, there's every chance it balances out. That's pretty much my thinking is it will last, as in the reopening will last, but it complicates everything. It complicates, what central banks are doing. It's a difficult one.
No, definitely, I'd agree. So Ryan's getting himself. Go on, David.
I think the best trade right now on the China reopening theme is long Tesla, and that's me. Because I'll tell you why. Because out of every company in the S&P 500, Tesla is most sensitive to Chinese sales. So if there's better sentiment in China, it's likely that Tesla's going to experience an uptick.
Why not get long the Hong Kong 50 that you can trade on Pepperstone?
Because the Hong Kong 50 is not concentrated enough to the specific idea, Ryan. That's why.
But diversification, buddy. Makes the world go round. Eggs basket,
But that's also called hedging, and hedges are for gardens. Do you know what I mean?
Gardeners.
Do you know what I mean? So, but also that idea would be predicated probably on the 10-year, being pretty muted as well. I wouldn't want the 10-year to get back to like 4%-ish, say. But I could see 20% in Tesla easily, back up to about 190-ish, something like that, maybe 180. So yeah, that would be something that I would look at for the China reopening play.
Mate, I tell you what, you want to get down Ladbrokes if you're punting like that.
Why?
And do you think it's got legs? Do you think this is now one way reopening back to normal, or is there any risk that they slam things into reverse?
Sorry to butt in, but I don't think you can ever say with any kind of confidence that China is one way forever, because they make the BOE look like straightforward in terms of policy kind of roundabouts. Sorry, but yeah, that's my 2 cents.
I agree with Ryan. I don't think you ever get the full picture from China.
No. The one thing, you can never, we know their data is manipulated, right? So it's not like you can say, based on the data, you haven't even got that as a benchmark. It's, it's basically whatever, the 12 people in, whoever, the handful of people in power want you to know, or whatever. This is why China is so difficult to invest in, full stop. And it's, how many people have gone bankrupt, or how many funds have blown up trying to call China right. You could argue that this is, if you are going to invest in China, this is probably the best time in a long time, because we are starting from a very a decent foundation of pardon my French, but shitness. Gun to my head, I would not be investing in the Chinese reopening unless I had a gun to my head. If I did, it'd be long copper. But
that was pretty much my point as well. It's like there's no point in even touching the narrative, really. There's so many piles of turds in China going on at the same time that it just and then obviously what was just discussed with regards to them pretty much making stuff up, hiding stuff. It's just a minefield, and it's just adding complexity, I guess, when it's not needed. But if I had to make a trade, I would base it off of Tesla having a lot of Chinese sales and getting long it.
Do you totally discount the concept of China going to Taiwan? I know there's a very narrow window when they can do that.
There was a recent thing from who was it, Ryan? You probably know, and he said that he's going to make a trip to Taiwan, and then the Politburo came back and said, if there's anything in the Taiwan Strait, then we're going to be pretty aggressive, isn't it? Like that.
I think it's
coffee.
I can't remember who said it, but in reply to Dickie, the threat is always there. Personally, I think it will just always remain a threat, because it's one of those things. Once they play the card, they can't play it again. And it just gives them so much leverage in terms of threats, and it keeps eyes on that whilst they're doing other things. You know what I mean?
But my worry is that things really do go pear-shaped in terms of COVID on mainland China, which we haven't got a clue whether they're good or bad, the number of deaths and whatever, that they all want to distract from domestic problems. And a good foreign war is always a good way to detract.
Yeah, I want to end around with you, Dick. We are very, very close to running out of time. So China reopening, Dick, what's your best trade idea to get exposure to that theme if you were going to?
On my basis that they're going to go and hit Taiwan, I'd buy that.
Well, that brings the fourth and final round to an end. So let's have a look at how our panelists have fared and have a look at the final leaderboard. Well, there we go then. So, Dick, unfortunately, your long euro sterling view, which put you in pain to give us, has not been enough to rescue you from last place. David coming in second, and rather annoyingly, Ryan sans yellow hoodie this week, coming home in first. Ryan, well done, mate. Congratulations.
How much are you paying for that?
Your parents and all the rest of it, and your little.
I'd just like to thank the academy and.
How much did you pay him for that, Ryan?
Well, I've got to pay him in kind later. That's what I'm worried about.
Well, before we get into any of that, thank you very much, gents, for joining us this week. Dick, David, and Ryan are all over Twitter. Dick Matthews from Pardus FX, David from Macrodesiac, and Ryan Paisey from PIQ. A couple of you will be back for Trading Blows next week. We'll have this whole panel together again, if I can speak. It's been a long morning already. In a couple of weeks' time, you can find a whole load more market content on all of our sites and on traderx.com. But for now, thank you very much for watching, and hope to see you again soon. Goodbye for now.